Listen closely because what's happening in silver right now is not a polite drift higher. This is the kind of move that leaves people behind, and if you're waiting for permission to pay attention, you've already missed the signal. In the last few sessions, silver didn't creep. It launched. We're looking at silver hovering near $90 an ounce after a violent push from the mid-80s in just 2 days. 2 days. That pace matters because speed changes psychology, and psychology changes everything in markets. Here's the uncomfortable reality. When silver starts behaving like this, most investors do one of two things. They freeze or they chase. And right here, at this exact moment, is where winners get separated from losers. The people who profit aren't the ones screaming the loudest on the way up. They're the ones who understand what's driving the move, what could fuel the next leg, and what signs would warn that a pause, shakeout, or reversal is forming. Now let's get into it, because this isn't just silver is up. This is a chain reaction. Policy shifts, geopolitics, supply pressure, market structure, and a mining sector that hasn't fully absorbed what just happened. And that lag is exactly what you need to focus on. First, the move itself. When silver accelerates, it doesn't do it gently. Historically, silver bores people for extended periods, then moves in ways that embarrass anyone who said it'll never happen. So when you see silver ripping from roughly $50 to near $90, that's not just a chart pattern, that's repricing. The market is reassessing the metal, not just trading it, and once repricing starts, it usually doesn't finish in a week. That's why you're hearing aggressive targets now, numbers like $130 or even $140 for next year being mentioned in serious conversations. Can I tell you the exact top? No, nobody can. But I can tell you this. When big targets start appearing after a breakout, it usually means we're leaving the old world and stepping into the volatile part of the cycle, where sharp swings become the price of admission. And that brings us to the next critical piece. This move didn't happen in a vacuum. There's a real-world trigger, and it's not speculation or hype. It's supply control. At the start of this year, China implemented additional export controls on silver, restricting exports to state-approved entities only. Now pause and think about what that means. Even if silver isn't mined in China, massive amounts of metal flow through Chinese refining, processing, and logistics systems. When policy like this hits, it doesn't just slow shipments, it introduces friction into the supply chain. Delays, bottlenecks, fewer ounces showing up where they're needed, when they're needed. And when a market is already tight, adding friction is like throwing gasoline on dry wood. But this move also signals something deeper. Governments are waking up to the strategic value of metals. They did it with rare earths. They did it with other critical materials. Now you're watching it reach precious metals with heavy industrial demand. Because silver isn't just a store of value. Silver is functional. Electronics, energy systems, industrial applications, things that matter when nations compete. When export controls appear, it's not just an economic decision. It's a geopolitical lever. That brings us to geopolitics. We've already seen major turbulence early in 2026, and regardless of how you feel about global headlines, markets care about uncertainty. Uncertainty drives hedging. Hedging drives flows. Flows drive price. So the question becomes, how much of this silver move is safe haven demand versus fundamentals? The honest answer is both. But the bigger engine, the one that tends to run longer than any single crisis, is the one most people ignore because it sounds boring. Debt, money creation, currency dilution. If you want one clean way to understand why gold and silver drift upward over long periods, pull up a chart of money supply over decades. It's not a straight line, it's a curve. And that curve tells you what paper currency does over time. It expands. When currency expands faster than real goods, the unit value declines. Metals, especially monetary metals, act like a scoreboard. They don't get expensive. The currency gets weaker. Now add geopolitical stress on top of that foundation. And you're not just adding fuel. You're adding wind to a fire that was already burning. Yes, wars, tensions, and uncertainty matter. But even if headlines go quiet for a month, the monetary engine doesn't turn off. And that's why this move in silver feels different to many people. It's not just a spike, it's the market admitting the old price environment was incorrect. If that's true, the next question is obvious. If silver is moving like this, why aren't the miners screaming higher? This is where confusion creates opportunity. When miners lag the metal during a fast move, it often means the sector hasn't priced in the new reality yet. Miners tend to follow in sequence. First the major producers, then mid-tiers, then developers, then explorers. And the early part of that sequence often shows up when companies report earnings into a higher metal price, because an extra dollar in metal price doesn't just add a dollar of profit. For producers, it can flow straight to the bottom line with minimal extra cost. Zoom in on the numbers. If a producer was selling silver around $40 in a previous quarter, and prices are now near $90, that's a massive gap. Even if costs rise slightly, the margin expansion can be brutal in a good way for shareholders. When those quarterly reports hit and people see the cash generation, the market tends to re-rate the stocks. That's why the next few reporting cycles matter. You may be watching the setup for the catch-up trade. And the most dangerous thing you can do is assume miners will never respond. They respond, just not on your preferred schedule. Projects that didn't make sense at low prices start making sense fast at higher prices. And that changes what a company can do, what it can finance, and what kind of buyers start calling. Let me give you a real-world example of how this plays out. Consider a Mexico-focused silver exploration company operating in the Sierra Madre region. This company has built out a pipeline of 4 separate discoveries. One of those discoveries is newer, high grade, and already has a resource base measured in tens of millions of ounces. They reported a maiden resource around 54 million ounces, and they're drilling aggressively with the goal of pushing that number closer to 100 million ounces. They've got a large drill campaign underway, 50,000 meters planned, and they're already well into it with steady results expected throughout the year. I'm telling you, this not to sell you on a ticker, but to show you the logic of how silver bull markets pull the entire ecosystem upward. When metal prices rebase higher, the market starts rewarding 2 things: scale and grade. A high-grade discovery can work at lower prices, but when prices rise, high-grade projects become magnets. And when a company has multiple deposits, the optionality becomes enormous. Here's the part most people miss. Optionality isn't just nice. Optionality is leverage. At $25 silver, maybe only the flagship deposit is exciting. At $90 silver, suddenly the secondary deposits start looking like they could be real mines. And that's where the story changes. Because the moment a company can start advancing more than one project at a time, you're no longer talking about a single-shot explorer. You're talking about a pipeline. And a pipeline is what bigger players look for when they want to acquire growth without doing the early messy work themselves. Now let's zoom into what this drilling work actually looks like. When a company says they're drilling 50,000 meters, they aren't randomly poking holes. They sequence the program. Early meters focus on stepping out from known mineralization, expanding the edges, deepening the zones, testing continuity. That matters because markets pay for confidence. A resource that grows not just in size but in consistency becomes easier to model, easier to value, and easier to finance. In recent results from a program like this, the company drilled multiple holes across several veins, including deeper step-outs that tested the system at depth. The key takeaway wasn't just that they hit mineralization, it was that the widths held up, the system stayed open, and the zones didn't pinch out the way skeptics love to assume. In parallel, they also hit encouraging grades and widths in adjacent structures that haven't been drilled as densely yet, areas with lots of room left. That combination, expansion plus new potential, is exactly what you want in an ongoing campaign because it creates a story where each batch of results extends the runway. And runway equals attention. Attention equals liquidity. Liquidity equals valuation. So what's the end game? Every investor eventually needs to know what the company is aiming for. In a typical path, the goal is to de-risk the asset while keeping options open. That means keep drilling, expand the resource, start baseline environmental work, begin the long lead permitting steps, and initiate economic studies. Not because they want to build a mine tomorrow, but because those steps add value and make the asset easier for a larger producer to buy. And yes, the preferred outcome in many cases is an acquisition. If you already have a producer with operating teams, capital access, and processing expertise, they can often unlock value faster than a junior can. But here's the power move. If you prepare as if you're going to build, you can negotiate as if you don't need to sell. And that shifts leverage to you. Now let's continue, because the biggest misunderstanding in silver right now is what a new base means. Every major cycle has a reset. Think about the early 2000s into the early 2010s. Silver broke above old ceilings, ran hard, eventually cooled down, and formed a new, higher floor. The old base was a few dollars. Then it became something like $20. Now we're entering a phase where a brand new base may form again. Nobody knows where it will settle. It could pull back. It could consolidate. It could whip violently in both directions. But the act of breaking into a new zone is important because it can permanently change what projects are economic. That's why companies with multiple deposits are suddenly re-evaluating assets that looked marginal just a year ago. One deposit, for example, has a resource in the measured and indicated category around 50 million ounces, plus additional inferred ounces with average grades around 100 grams per ton in an open pit context. At mid-30s silver, the financial models started looking interesting. At prices far above that, you don't need imagination, you need a calculator. And that's why you could see a project like that move toward a preliminary economic assessment without requiring years of new drilling. Sometimes the data is already there. The price environment is what changes, so the pipeline can accelerate. And this is where the mining sector can wake up in a hurry, because if a developer can publish economics that look strong at current prices, you suddenly get a wave of attention not just from retail, but from institutions and strategic buyers. Now let's switch gears and talk about what could derail this, because every parabolic move creates a trap. The trap is believing price only goes one direction. But bull markets don't move in straight lines. They move in lunges, then they breathe, then they lunge again. Silver especially loves to punish both sides. It punishes late buyers with sudden drops and early sellers with violent recoveries. So if you're watching this thinking, I missed it, it's too late, you might be wrong. But if you're thinking, I'm up, it's safe, nothing can stop it, you might also be wrong. The smarter approach is to understand what phase you're in. We are in a breakout phase. Breakout phases can overshoot, but they can also be the start of a multi-year run. And that's why the bigger question isn't what happens tomorrow. It's what kind of cycle are we entering? There's a view that this could resemble the 2002 to 2012 commodity bull market period, not just in silver, but across commodities. And if that's the case, the silver move you're seeing now may be the opening act, not the finale. In those cycles, gold often leads, silver follows later, and then silver tries to catch up by moving faster. That's exactly what many people feel is happening right now. Gold has been strong for a while. Silver was late. Now silver is sprinting. If you've been around markets long enough, you've seen this movie before. Let's go back to China's export controls for a moment, because I want you to catch the nuance. Some people hear export controls and assume China is running out of silver. Not necessarily. What it can mean is the state wants more control over where strategic metal goes and under what terms. It can also be a signal to other nations, we have levers. And when nations start using levers, markets start adding risk premiums. Risk premiums show up as higher prices. Even if the actual volume impact isn't massive at first, the psychological impact can be. When availability becomes uncertain, buyers get nervous. Nervous buyers don't wait for dips, they secure supply. Pair that with industrial demand and potential shortages, and you can see why a tight market can go explosive. But again, this doesn't mean straight up forever. It means the environment is primed for violent moves. Now let's talk about the human element, because the silver story isn't just charts and policy, it's also psychology. When a metal sits in a range for years, it trains people to ignore it. Then when it breaks, it trains people to chase it. That's why the most valuable skill right now is not predicting an exact price. It's staying rational in an irrational market. That's why I want to ask you something, and I genuinely want your answer in the comments. Do you think silver forming a new base happens above $50, above $70, or does it surprise everyone and settle somewhere nobody expects? And second question, do you think miners will catch up in a big way this year, or does the metal continue to lead while equities lag? Drop your thoughts below. I read the comments, and it helps shape what I cover next. And while you're there, if you're doing well, if you've had a win in metals, mining stocks, or your investing journey, share your experience in the comments. It helps other people and shows that real progress is possible. Now let me add a piece that mainstream coverage rarely explains properly because it's not exciting enough for headlines, but it's exactly what makes people late to the move. When silver breaks out, the first wave is usually price discovery in the metal itself. That's when futures traders, physical buyers, and macro funds start adjusting positions. The second wave is the equity market slowly realizing that higher metal prices change the math for mining companies. And the third wave, this is the one most people miss, comes when capital markets reopen for the sector. In weak silver environments, the junior space can feel like a desert. Financing is expensive, dilution is brutal, and even good projects struggle to get attention. But in a strong silver tape, the doors start opening. Investors stop asking, "Why should I care?" and start asking, "How do I get exposure?" That shift can take time, but once it happens, it tends to feed on itself. More attention brings more liquidity. More liquidity brings higher valuations. Higher valuations make financings less painful. Less painful financings allow more drilling and development. More drilling creates more news flow. More news flow attracts more attention. Suddenly you have a feedback loop. That's why I keep using the word repricing. Because repricing isn't a one-day event, it's a process. Now here's where things get interesting. In the silver mining world, the market often values companies like a story, and stories need catalysts. Let me list out the types of catalysts that can keep a silver narrative hot in 2026 and why they matter. First catalyst, continuing drill results from the flagship discovery. If a company is drilling step-outs and consistently expanding the mineralized envelope, each set of results reinforces the idea that the resource can grow. Resource growth is one of the simplest ways to justify a higher valuation without needing metal prices to go up again. Second catalyst, a resource update. Markets love clean milestones. Moving from a maiden resource around 54 million ounces toward a larger number, say closer to 100 million, creates a before and after moment that people can anchor to. Third catalyst, shifting a secondary deposit from interesting to economic. This can happen when a company initiates a preliminary economic assessment or even just announces they've started work toward one. Because that signals confidence, the numbers will tell a positive story at current prices. Fourth catalyst, permitting and baseline work. Fifth catalyst, strategic interest. This doesn't always show up as a public announcement. Sometimes it shows up as unusual volume, tighter spreads, or a slow grind upward that doesn't match the general market. If a bigger player is circling, you'll often see hints before you see headlines. Notice something. None of these catalysts require silver to go from $90 to $140 immediately. They require execution, And execution is what separates a chart that went up from a company that can create value through a cycle. So if you're trying to position yourself, it's not enough to say, silver bull market. You need to think, which parts of the food chain benefit first, and which names have the ability to deliver catalysts, regardless of daily price swings. Now let's address the ETF point, because it's an important clue. There's a well-known silver miners ETF that many people watch, and lately, it has only barely outperformed silver itself, if at all. That's unusual during a sharp metal rally. But unusual doesn't mean wrong. It often means early. During the initial breakout, investors sometimes pile into the metal because it's the cleanest exposure, the easiest story, the simplest hedge. Stocks, on the other hand, require decisions. Which producer, which country, which balance sheet, which mine life, which hedges, which political risk. That complexity can delay the equity wave. But when it flips, it can flip hard. Once people become convinced the price regime is higher, they stop treating miners as speculation and start treating them as cash machines or takeover targets. And that's when you get those days where miners run multiples of the metal's move. Here's another cliffhanger for you. If silver holds a high base for long enough, you may see a wave of mergers and acquisitions that surprises the public. Why? Because producers don't like building new mines from scratch if they can buy de-risked ounces, and juniors if they've done the work, resource, baseline studies, early economics, can become shopping lists. So while everyone argues about the daily candle, bigger money can be planning 3 years ahead. Now let's talk about Mexico, because it comes up a lot and it matters. Mexico is historically one of the world's most important silver jurisdictions. It has geology, history, and established mining culture. But like any jurisdiction, it has layers of risk and complexity, permits, communities, policy shifts. That's why having an experienced local team matters. It's not just about drilling. It's about relationships, logistics, and getting things done without burning bridges. A company that's been operating there for years, with a stable on-the-ground crew, a disciplined approach, and a track record of discoveries, has a different profile than a newcomer trying to learn everything during a bull market. Now I want to underline something else. The 4-deposit concept is not just marketing. If you have 4 deposits, you have options. You can advance the flagship while you study another. You can decide which one deserves capital first. You can sell one, joint venture another, and keep drilling the highest upside zone. And if you're dealing with a producer that's interested, you can offer a pipeline rather than a single asset. In negotiations, that changes the conversation from how much for your one project to how much is your growth platform worth. Here's a subtle point that can boost your understanding. In mining, the market often assigns different multiples to different stages. Pure exploration can be valued on excitement, but it's fragile. Development with economics can be valued on models and comparables. Production can be valued on cash flow, dividends, and reserve life. A company moving from explorer toward developer can get re-rated even if it hasn't poured a single ounce, because it's stepping into a category that more investors are allowed to own. Some funds can't buy pure explorers. Some institutions need a certain level of de-risking. So the company's stage can change the investor base. Now, if you're still with me, here's the big tension. Silver at $90 makes headlines, but the real wealth transfer often happens in the messy middle. The months of consolidation, the pullbacks that scare people out, the slow-building thesis that rewards patience. That's why I keep warning you. Silver will try to throw you off the ride. It may do it with a sudden $15 dump in a week. It may do it with a fake breakdown that reverses overnight. It may do it with a sideways grind that makes you bored and impatient. And that's exactly when people make mistakes. As we get closer to wrapping up, I'm going to give you a simple summary of what I want you to remember. 1. Silver has entered a new regime. The pace matters. 2. Policy moves like export controls can tighten markets and add risk premium. 3. Geopolitics can amplify safe haven behavior, but the bigger driver is monetary expansion over time. 4. Miners often lag first, then catch up as earnings and cash flow become undeniable. 5. Projects that looked marginal at lower prices can become valuable fast when the base price shifts higher. 6. The best stories in the space are often the ones with pipelines, strong teams, and disciplined execution. 7. Volatility is not a bug in silver, it's the feature. If you found value here, do the simple thing that keeps this channel alive: subscribe. And if you're still watching at this point, I want to hear from you. What level do you think silver reaches before it seriously cools off? Drop your answer below. Take care of yourselves. Take care of each other. I'll see you in the next one.